Bitcoin just wrapped up one of those weeks where neither side could claim victory. As of November 21st at 2:42 p.m. UTC, we're sitting at $85,015. This past 7 days told a story of ambition, and retreat. Price swung from a low of 80,600 all the way up to 86,460 before settling back where we are now. That's nearly a $6,000 range, about 7% movement in a week. By the end of this breakdown, you'll understand exactly what happened at each key moment and what it means as we head into next week. Let's walk through this week's journey, because it's a perfect example of what happens when momentum meets resistance. Think of this week like a rubber band. We started Monday around 81,000, the rubber band at rest. Over the next few days, bulls stretched that band upward, pulling and pulling until Wednesday when we hit 86,460. That's stretching the band nearly $6,000 higher. But rubber bands don't stay stretched forever. By Thursday, the tension released. Not a violent snap, but a controlled return to equilibrium. By Friday's close, we'd settled back at 85,000, still above where we started, but nowhere near that stretched peak. The week opened cautiously. Early on, around 81,000, buyers started testing the waters. By Tuesday, confidence built. Volume picked up, and we'll talk more about that later, but the key is people were participating. Wednesday became the high water mark. We touched 86,460, and for a brief moment, it looked like we might hold those heights. But that's where sellers stepped in. Not aggressively, but firmly. They pushed back, and by Thursday afternoon, we'd given back over $1,000. Friday saw us stabilize in the 84 to 85,000 zone, which is where we closed the week. Right now, at 85,015, we're in what I'd call the upper middle territory. We're not at the top anymore, that's 86,460. We're not in the middle either, that would be 83,530. We're somewhere between those two, holding ground above the midpoint but pressed against resistance above. The rubber band has relaxed, but it's not slack. There's still tension in this market. This week's price action was guided by 5 specific levels, and understanding where each one sits is crucial for next week. Let's walk through them, starting from the top and working our way down. 85,077, the shallow retracement zone. This level represents giving back about 23% of the week's move from that 86,000 peak. Think of this like a boxer taking one step back. After throwing a punch, it's barely a retreat at all. This week, price dipped below this level late Thursday and has been testing it repeatedly since then. Right now, we're sitting just under it at 85,015. That means we're pressed right up against it. This is the nearest ceiling, directly overhead. Breaking back above it would signal buyers are regaining control. Staying below it suggests the pullback isn't finished yet. 84,221, the moderate support zone. This represents a 38% retracement, and historically, this is where healthy corrections find their footing. Price tested this level briefly on Thursday afternoon when sellers pushed hardest. It bounced within hours, like a basketball hitting pavement. That quick reaction tells us there were buyers waiting at this level, ready to defend it. Right now, this is our nearest support floor, only about $800 below where we're currently sitting. If we break below it next week, it would signal the correction is deepening beyond the shallow phase. 83,530, the midpoint. This is exactly halfway between the weekly low and weekly high. It's a psychological line in the sand. Stay above it, and bulls can claim they're still ahead on points. Drop below it, and the narrative shifts to sellers taking control. We haven't tested this level this week, we've stayed comfortably above it. But it's sitting there about $1,500 below current price, ready to catch us if that 84,000 support fails. Think of it like a safety net beneath a tightrope walker. You don't want to need it, but it's there. 82,838, the golden ratio level. This 61.8% retracement represents a deeper pullback. We didn't come close to this level this week, which tells you bulls maintained reasonable control even during the Thursday sell-off. If we ever get down here, it would mean giving back more than 60% of the week's entire climb. This is where the character of the market would shift from healthy correction to losing momentum. It's currently about $2,200 below us, not on the immediate radar, but worth knowing it exists. 81,854, the deep retracement zone. At 78.6%, this level is close to the weekly low of 80,600. Reaching here would essentially erase the entire week's work. We started the week around here and climbed away from it. Coming back would be like that rubber band snapping all the way back to its starting position. Right now, it's about $3,200 below us distant, but these things can move faster than you expect. Here's what this structure tells us. We're currently sandwiched in a narrow band. Less than $100 above us is resistance. $800 below us is support. That's a tight squeeze. When price gets compressed like this, it usually doesn't stay compressed for long. Something gives: either buyers push through overhead resistance, or sellers crack the support floor. Next week will likely resolve this compression one way or the other. Let's zoom in on the immediate battlefield, because this is where next week's direction gets decided. The support floor beneath us at 84,221 has proven itself this week. When price dropped there on Thursday, it didn't hesitate or linger, it bounced. That bounce wasn't weak or tentative. It was decisive, with volume backing it up. That tells us there are buyers positioned at this level, likely limit orders sitting there waiting to catch dips. If this level breaks next week, those buyers are gone, and we're falling to the next safety net at 83,530, the midpoint. That would shift momentum decidedly in favor of sellers. The resistance ceiling above us at 85,077 is where price keeps hitting its head. We've tested it multiple times since Thursday evening. Each time we get pushed back. It's not a violent rejection, more like pushing against a door that's locked. You feel the resistance, you back off, you try again. The fact we keep coming back to it shows bulls haven't given up. They want through that door. But wanting isn't enough. Breaking through requires volume. We need to see participation jump above the already high levels we've been seeing. More on that in a moment. Right now at 85,015, we're in the narrow hallway between these two levels. We've got less than $100 of headroom above and $800 of floor space below. It's like being stuck between floors in an elevator that won't decide whether to go up or down. This compression creates tension. Markets don't like tight ranges, they resolve them. Next week, we'll see that resolution. Volume this week was high, more than 1.5 times the average. That's significant because it means these moves weren't happening in a vacuum. Lots of participants, lots of conviction on both sides. High volume during Wednesday's climb to 86,000 meant bulls believed in that move. High volume during Thursday's pullback meant sellers had conviction too. When you see high volume in both directions like this, it signals genuine disagreement. That's why we're stuck in this tight range. Neither side has overwhelmed the other yet. The MACD histogram tells an interesting story here. It flipped positive late in the week at 81.13. The main MACD line sits at negative 1563, signal line at negative 1645. What matters most is that histogram. Think of it like watching a car that was rolling backward finally shift into neutral, then first gear. It's not accelerating yet, but it stopped going in reverse. The MACD crossed above the signal line, suggesting downward momentum from earlier is weakening. For next week, if this histogram keeps climbing, if that car shifts into second gear, it would confirm bulls are regaining momentum. If it rolls back negative, sellers are winning. Let's map out where price could head if buyers manage to crack that 85,000 resistance and push higher. But remember, we're currently sitting below that resistance. Before any of these targets matter, we need to break 85,000, then reclaim the weekly high at 86,460. Think of it like planning which floor to visit when you're still waiting for the elevator doors to open. First target sits at 88,053. That's the 1.272 extension, about $1,600 above the weekly high. If we break through 86,460 on strong volume next week, this is the first natural stopping point. To reach it, we'd need a couple things to align. Our RSI would need to push into the upper 50s or low 60s without hitting overbought territory above 70. Volume needs to stay elevated, ideally above that 1.5 times average we've been seeing. And we'd need to see 86,000 hold as new support once we break it. You don't climb a ladder by skipping rungs. This target is achievable if momentum builds steadily over several days. Second target is 88,885. That's the 1.414 extension, about $2,400 above this week's peak. This level requires sustained buying pressure, not just a one-day spike. Markets don't go straight up without pausing to catch their breath. We'd need to establish 88,000 as a base before attempting this level. Think of it like climbing a mountain. You don't summit in one push. You climb, set up camp, rest, then climb higher. This would likely take the better part of next week if everything aligns perfectly. The full extension target sits at 90,080, the golden ratio target at 1.618. That's $3,600 above the weekly high, essentially adding another 5% move on top of this week's 7% range. For this to happen next week would require something dramatic, a major catalyst, sustained institutional buying, volume staying consistently high, and RSI managing to stay strong without flipping to overbought on pullbacks. More realistically, this is a multi-week target if the uptrend continues building momentum. Don't confuse mathematical possibility with probability. Yes, price could reach here. But would it require everything to go right, with no meaningful resistance along the way? Absolutely. Here's the reality check. We're currently at 85,000 pressed against resistance. The nearest obstacle is just $60 above us. Then 86,460. Then these extension targets. It's a series of hurdles, not a straight shot. Focus on what's immediately ahead. Can we break 85,000? If yes, can we hold it? Then we worry about 86,000. The extensions are mathematical projections showing where momentum could carry us if it builds progressively. They are not predictions. They are possibilities that require specific conditions to activate. Now let's look at what happens if that 84,221 support floor gives way, because it's only $800 below us and tested already this week. If support breaks, the first landing is the midpoint at 83,530. That's about $1,500 down from current levels. Breaking below it would flip the week's narrative from buyers slightly ahead to neutral ground. This level matters psychologically because it's exactly halfway between the weekly high and low. Markets pay attention to round numbers and significant levels like this. It wouldn't be a panic drop, more like walking downstairs to the next landing. Volume would tell us everything about whether it's a controlled move or the start of something more serious. High volume breakdown suggests conviction. Low volume suggests weak follow-through and possible reversal. Next floor down sits at 82,838, that golden ratio level, at 61.8% retracement. This is about $2,200 below current price. Reaching here would mean giving back more than 60% of this week's entire climb from 80,600 to 86,460. This is where the 50-day moving average might become relevant. Remember, it's sitting up at 88,640, about 4% above current price. If we drop to 82,000, we'd be over 7% below that moving average, which historically signals deeper correction territory. If we fall all the way back to the weekly low at 80,600, it would erase everything this week accomplished. All that climbing, all that effort to push higher, wiped clean. This level matters because it's where the week's range began. Breaking below it would open the door to those deeper downside extension targets 76,979, 74,740, eventually down to 73,000 or lower. But let's be realistic about next week specifically. These deeper extensions are unlikely unless something breaks fundamentally. The more probable scenario for next week is testing support at 84,000, possibly the midpoint at 83,530 if that breaks. The deeper levels are multi-week concerns if the structure deteriorates progressively. What would stop a decline? Watch for these signals, high-volume bounces that show buyers stepping in with conviction. RSI dropping toward oversold territory, below 30, we're at 44 now, so we've got room to fall before reaching panic levels. The 50-day moving average could act as a magnet pulling price back up if we drift too far below it. And finally, those Fibonacci levels themselves, each one represents a zone where previous buyers might defend their positions. Think of downside support levels like a series of trampolines stacked below you. If you fall through one, the next one might catch you. But each one you fall through weakens confidence that the next will hold. Right now, we're standing on solid ground at 85,000. The first trampoline beneath us at 84,000 has already proven it can catch a fall. It did so Thursday. The question is whether it holds on a second test or if the springs are weakening. The price tells us where we've been. The indicators tell us how strong the moves were and how sustainable they might be. RSI closed the week at 44.09, sitting comfortably in neutral territory. Think of RSI like a pendulum. Above 70, it swung too far to the optimism side, overbought. Below 30, it swung too far to the pessimism side, oversold. Between 30 and 70 is normal range, and 44 is slightly below center. This week, RSI likely climbed into the upper 50s or low 60s when we hit that 86,000 high on Wednesday. Then it cooled back down as price pulled back. The fact we're at 44 now means there's breathing room in both directions. We're not overbought where bulls are exhausted, and we're not oversold where bears have pushed too hard. It's neutral ground, which matches the price action stuck between support and resistance, with no clear winner yet. The MACD tells the more interesting story this week. The histogram flipped positive at 81.13. The MACD line itself sits at negative 1563, with the signal line at negative 1645. Here's why this matters. When the MACD line crosses above the signal line, the histogram goes positive. That's what happened late this week. Think of it like watching a pendulum that was swinging toward the pessimistic side finally reach the bottom of its arc and start swinging back toward optimistic. It hasn't reached center, yet both lines are still negative. But the direction changed. The histogram turning positive suggests downward momentum is weakening, and early signs of reversal are appearing. For next week, watch if this histogram continues climbing. If it does, it confirms bulls are building momentum. If it flips back negative, sellers are reasserting control. Volume this week was consistently high, more than 1.5 times the average daily volume. That's like comparing a packed concert venue to a half-empty practice session. High volume means conviction. Lots of participants, lots of capital moving, lots of opinions being expressed through buying and selling. We saw high volume during the climb to 86,000 bulls believed in that move. We saw high volume during Thursday's pullback, sellers had conviction too. When volume stays elevated in both directions like this, it signals genuine disagreement about fair value. Nobody's dominating. It's a real battle. For next week, if volume drops off significantly, it suggests indecision and likely continuation of this tight range. If volume stays high or increases, expect decisive moves either breaking through resistance or cracking support. Volatility this week was actually low despite that $6,000 range. The ATR average true range came in at 1.7%. That might seem counterintuitive given the 7% weekly swing, but ATR measures the average size of individual candle moves, not the total range. Low ATR means price moved in controlled steps, not wild jumps. It's like the difference between climbing stairs steadily versus jumping up and down unpredictably. The steady climb to 86,000 and controlled pullback to 85,000 happened in measured increments. For traders, low volatility means tighter stop losses and more predictable price behavior. For next week, if volatility stays low, expect continued grinding. If it spikes, be ready for sharper moves. Bringing it all together, here's where we are and what to watch. We're at 85,015, squeezed into a narrow band between 84,221 support below and 85,077 resistance above. The 50-day moving average is pulling from above at 88,640, about 4% higher. We're holding ground above the weekly midpoint, which gives a slight edge to buyers, but we're pressed against resistance that's kept us in check since Thursday. The market's in neutral gear, high volume showing participation, but no clear direction yet. RSI and MACD both suggest momentum could shift either way. The key level for next week is 84,221, that support floor we tested Thursday. If it holds on another test, we're still in the game for pushing back toward the weekly high. If it breaks, we're walking down those stairs toward 83,530, the midpoint. Everything pivots on whether buyers can defend this level or sellers can crack it. If bulls win, break 85,000 first. Not just touch it, but close above it with volume. Then push toward 86,460, the weekly high. If that breaks, 88,000 is the first extension target. That's a three-step progression: 85, then 86, then 88. Don't skip steps. If bears win, break 84,221, which opens the door to 83,530, the midpoint. If that cracks, we're testing the weekly low at 80,600. Below that, deeper extensions come into play. Again, steps, not cliff diving. Each level will likely provide temporary support before the next leg down if selling pressure builds. The Fibonacci structure continues to guide every move. These aren't random numbers or wishful thinking. They are the mathematical framework that defined every significant reaction point this week: Wednesday's peak, Thursday's bounce, Friday's stabilization. That structure will guide next week too. We're not guessing where price might go. We're watching the levels that have proven themselves and waiting to see which side wins the battle. That's where we are. That's what to watch.